Just like everyone, you might have been thinking about investing. How to invest, how to get rich so you can enjoy the rest of your life stress-free, secure your children's future, and live well in your retirement. You probably are dreaming right now of the life you are going to have if you become rich and wealthy. The nice cars, the big houses, travel the world, live a luxury life, and enjoy your financial freedom. But is this something far away from achieving for normal people? Can I do it myself? You might ask. What about these people promising me to become rich if I follow their secret trading formula? What if I told you there is a proven way that can safely assure you growth in your wealth and can help you enjoy a good life for you and your loved ones? This is called investment. But what is investment, how to invest, where to invest, and most importantly, what to invest in? You might be overwhelmed with all the options available out there when making an investment decision. The options seem endless. You can invest in shares, bonds, funds, real estate, foreign exchange, cryptocurrency, ETFs, NFTs, fine arts, and even classical cars. In this video, I'm going to share with you everything you need to know about investment. The word investment might sound sophisticated or complicated, and the aim to get rich or become wealthy is quite often seen as long, hard, and unachievable, and sometimes even impossible. This is one of the reasons why people somehow shy away from investing and stop pursuing the goal of securing a wealthy future. So what does it take to invest to get rich? Where to start? And most importantly, what do you need to learn in order to start the journey to invest? Investment is buying assets like stocks, bonds, or real estate, with a goal in mind to generate income in the future and grow in value. Basically, it's giving away things like money, time, efforts, and knowledge in exchange for a bigger reward in the future. But before we get started on how to invest, and before getting excited and start to dream about the future wealth and what to do with the money and how to spend it, let me ask you a question. Do you even have the starting capital to invest? You know what I mean, the money, the dollars, the dineros. If you start thinking, I'm too young and don't have the capital to get me started, so this video is not for me, let me tell you you're wrong. Because investing starts earlier than you think and with no capital at all. And if you're older and think it's too late to learn about investment, you're wrong too. Just remember how many people you know lost all their life savings trusting the wrong financial advisor and maybe putting their money into investment that doesn't suit them in the first place. Let's start with you, young man. As I said, investing starts at a very early age, way earlier than you think. But I also said that we need capital. At this point, it's not the financial capital we are after human capital. Yes, you heard it right. Let me say it again. Human capital. From the day you are born, your learning curve is getting steeper and steeper. You start acquiring all the skills that you need to survive and communicate. Then you go to school, start to learn numbers and letters. And then you learn math and grammar and other subjects. And you keep on learning until you reach a point where you are ready to start working and make a living. What you have done so far was the first stage of investing. It's called investing in yourself. And without knowing, you have built a human capital. But unfortunately, at this stage, we are still with no financial capital. And maybe at this point, you are already in debt with a student loan. But don't worry, the upfront investment of time attending class and the money to pay for tuition will hopefully result in increased earning in your future career. Remember, at this point, your human capital is at its highest level and is still growing. You are ready now to exchange this human capital with financial capital, salaries, earnings, profits, you name it. You'll notice that your financial capital is increasing with promotions, commissions, and bonuses, but not enough to start meaningful investment. That's because you need to build a bridge to get you to investment land, and this bridge is called savings. No matter how hard you try to convince me that you can't save, I'm not buying that. Everyone can save. I am going to talk in this channel about different ways to help you save money, but in the meantime, I'll give you simple steps to help you start. Number 1, start putting any amount aside, even if it is as little as $1. Why? To start building the habit and the discipline of saving. Continue until you are able to put 1/3 in savings monthly. Number 2, stop buying things you can't afford now. No loans or credit cards. Use them only in the case of emergency. Number 3, don't start investing until you have money set aside to cover at least 6 months of all living expenses. If you lose your job, the last thing you want to do is to sell your investment to cover your living expenses. Most of the time, you'll end up losing money, especially if this happens shortly after you start investing. To better understand the art of investment, we have to set the grounds with some rules and some basic stuff. Risk. No one has ever said that all investments are going to make money and achieve all your financial goals. Unfortunately, it doesn't work that way, and some investment will lose some or all the money invested. Some of the companies you invested in their stocks or bonds can go bankrupt or might turn out to be a scam. As there are so many types of risks to talk about, I'll give you some main points to consider. Risk tolerance is the level of risk and uncertainty that you can afford and are willing to take. Risk and return trade-off. The higher the return you try to achieve, the higher the risk expected. This is why stocks are more risky than bonds, because they promise higher return. Time horizon. The longer the time horizon of the investment, the more risk tolerant you become. This is why young people are said to have high tolerance toward risk, because they still have longer time to recover from any losses in investment. Risk is volatility. Risk is measured with volatility of return. The more your investment fluctuates in price, the more risky it is compared to a less volatile one. You would have noticed by now that risk tolerance is how much risk you are able and willing to take when investing. And allow me to stress these two words again, able and willing to take risk. There's a huge difference between your ability to take risk and your willingness to take risk. For example, if you are young, you have the physical strength and ability to take on risky kind of activities. You can decide to do bungee jump or mountain climbing, but at the same time, it depends on whether you are willing to do these kind of activities or not, even though you have the ability to do so. So in this case, you honor the lesser of the two, able, not willing. And in investment, it's the same. A young professional has the ability to invest in risky investments like stocks. On the other hand, someone at the age of 65 might have a strong desire to invest in risky assets, but unfortunately, he doesn't have the ability due to his age, and hence, he is encouraged not to do so and to honor the lesser of the two, and in this case, his ability. People in general fall between two types. They're either risk-averse person or risk takers, or they can be in between. Psychology. Another thing we need to establish here is some psychological factors that plays a huge part in determining your risk tolerance. For example, let's take the perception of wealth. You probably have seen someone who only have $10,000 and thinks he is filthy rich. And at the same time, you may have known someone with millions, but his perception of wealth is that he has little. The first might be delusional about his ability and could put his savings into too much risk. The second might have misperceived the true ability of his wealth and could deprive himself from good investment opportunities and returns. But nevertheless, we have to respect his will. Other psychological aspect is any regret from bad investment experience in the past, or maybe a false feeling of power from a lucky investment. It's always good to know at what stage we are in the economy in terms of the business cycle, as the way you invest depends on whether the economy is in recession or if we are facing high levels of inflation. Although it's not advisable to try and time the market when planning a long-term investment, unless you are an experienced active trader, it doesn't harm to know that some investments protect you at times of recession and others are your fortune maker when the economy is booming. You probably heard it from your grandmother. Don't put all your eggs in one basket. This simply means that you have to diversify your investment in different asset classes. In other words, spread the risks. At times, some investment may be losing in value and others are stable or increasing, providing your portfolio with a level of protection. We covered some of the main elements surrounding the investment process, but not everything. And as the purpose of this video is strictly educational, please don't treat anything mentioned here as a financial or investment advice. It's encouraged to get some professional help from a financial advisor or an experienced portfolio or assets manager. Let's explore what type of investment are available out there for someone to invest in. Cash is king. That's always true. If you don't believe me, try selling a house or a land in times of recession. But don't invest too much into cash, because cash loses its purchasing power over time with inflation. In other words, you buy less with your money with the passage of time. A bond or a fixed income security is a type of a loan to a company, institution, or sometimes to governments. If you buy a bond, you agree to lend money for a period of time for a fixed or variable interest rate called a coupon. After the term of the bond ends, or when it matures, you get your money back. In a nutshell, bonds are lending money to a company versus stocks are owning part in a company. We will cover investing in bonds and fixed income securities in more detail in future videos, so make sure to subscribe and hit the bell button. Investing in stocks. Buying a stock means that you own a share in a company, so technically speaking, you are an owner. By owning shares, you are entitled to dividend if the company makes profit and decide to distribute some or all of these earnings. If the company becomes more successful, it will be very attractive to other investors and they now want to buy it. This demand will make the price goes up and you will make capital gain if you decide to sell. But unfortunately, the opposite scenario could be true, where poor performance of a company can lead to a loss in its share price. Stocks come into two types: common, where you get a voting right, and preferred, where often you have priority over dividends and must be paid before common investors. Stocks can be classified as growth or value investment. Growth investment is buying a company at early life in hopes it achieves market success, and value investing is investing in established companies where you think its real value is higher than its market price, or you want to enjoy a stable and good stream of yearly dividends. Where some people are afraid of buying individual stocks and feel safer in a well-diversified portfolio but don't have enough experience to pick these stocks, so they buy a fund. The most common ones are mutual funds and index funds. You can buy shares in a mutual fund that holds ownership of companies with a specific strategy, like for example, investing in small cap or large companies or even emerging market companies. Typically, these funds are actively managed, meaning that the investment manager of the fund is trying to beat a specific benchmark and generate higher return than the market. Index funds often follow an industry or the whole market, like investing in the S&P 500 market by investing in all the stocks in that market or a representative sample of this market. Real estate investment are investment in land, office buildings, warehouses, and residential properties. Real estate investment may encompass acquiring or developing sites for specific uses or purchasing ready-to-occupy operating sites. Real estate promises good returns in terms of rent and appreciation in value. The only downside is that it is considered illiquid investment, meaning it takes longer time to sell to get your cash back. But in the long run, it is considered a good investment and it made lots of people wealthy and financially secure. Commodities. Like investing in gold, silver, or other commodities such as agriculture, energy, or metals. You can buy the actual tangible commodities, like owning a bar of gold, or can invest in digital ownership like a gold ETF or a fund that invests in commodities. Collectibles. This type of investing is buying rare items in anticipation of becoming in high demand in the future. Examples are art, classical cars, sport memorabilia, and comic books. The older these items get, the higher the price. The list of what type of investment out there is huge and sometimes seems endless, especially with the invention of new asset classes like the cryptocurrency. In this channel, we'll cover most of the asset classes in other videos, in which we will look into detail into the nature of these types, the expected returns, and the associated risks. So make sure to turn the notification button for future videos. One important thing for you to remember is that just as you trust your mechanic with your car and your doctor with your life, investment does require a professional help of a financial advisor from a trusted investment firm, not your friend Bob from work. And finally, here's a list of very important things to always remember before you start investing. Number 1. Remember to do your own research. Even if you are relying on third-party advice, try to understand where are you putting your money and understand your risk tolerance or risk appetite. There are so many services and surveys in the market that can help you determine your risk appetite. Number 2, don't overlook your spending needs. Ensure you have enough capital to pay monthly expenses and that you have already built up an emergency fund of up to 6 months. Number 3, liquidity, liquidity, liquidity. I can't stress this enough. It's very important to understand how liquid is your investment and how fast you can turn your investment into cash without incurring losses. Cash is king. Also read carefully before you sign into any investment structure and always ask if the investment is locked for a period of time and you can't exit during that time. Number 4, do your research on tax implications and always consult your tax advisor. I hope I left you with some foundation to have safe journey towards investing your way to being rich. Thank you for watching and looking forward to see you in the next video.